We continue our discussion with the noted economist Nouriel Roubini, professor of economics at New York University's Stern School of Business. And Nouriel, as we talk about the U.S. economy, some of the people whom we serve at Yahoo Finance would say the yield on the 10-year bond is now approaching 1.4%. Another group of the people we would serve would say 10 million of our fellow Americans are still unemployed. Which would you be looking at as a measure of where we stand in this economic recovery?
About an overheating of the economy based on the fact that we have massive monetary and fiscal stimulus, that we are controlling the contagion, that we're going to have vaccines deployed, that financial conditions are easy. But I'm not sure about the overheating because studies suggest that out of the $1.9 trillion of the fiscal stimulus, most of it is not going to be spent, it's going to be saved because there are millions of households that are in arrears on their rent, on their utilities, television, cable, phone, gas, electricity, or they're not paying their mortgages or personal loans or credit cards or student debts. So out of the 1.1 trillion, I think at best 1/3 is going to be spent and the other 2/3 is going to be saved. If that's the case, then the growth impulse of the stimulus is not going to be as large. Secondly, the money that is recycled through savings is going to end up into treasury bonds and therefore is going to cap how much those treasury yields are going to rise. And three, is going to be a bailout not only of households, but also of credit markets, of banks and all the financial market credits that have lent to the households that are now under stress. So I think that if I'm right about this inference, we're not going to get overheating. The bond yields are not going to rise furthermore. We're not going to have in the short run an inflation burst, and we'll have a bailout of household that becomes a bailout of the credit markets that have rallied a lot, but they will have room to rally more than otherwise.
So Nouriel, correct me if I'm wrong, am I hearing you on this? So the $1.9 trillion stimulus, you don't think that's going to be excessive? If so, can we explore that a bit more? And also the implications, you said, 1/3 of it will be spent, most of that will be saved, and there'll be some that goes into the credit markets. What does that mean for the economy?
Well, it means that the economy is going to grow less because of the stimulus than otherwise. If only 1/3, about 600 billion is spent, that's about 3% of GDP as opposed to something that is closer to 10% of GDP. So there'll be some growth acceleration relative to a baseline without the stimulus, but not as large. And if the money then is recycled and saved in financial market, then I think that the worries of the bond market that the yields are going to go much higher may be proven ex post incorrect, because I think bond markets are worrying that now most of the money is going to be spent. And as I pointed out, if you're saving it and running out your debts and your arrears, then rise in non-performing loans, rise of defaults of households on the variety of their loans, mortgages, credit cards, student loans is going to be less than otherwise. And you could have further tightening of, say, spreads in credit market as well. So those are the implications of it.
But it's not too excessive.
Well, based on 1/3 spent and 2/3 being saved, it would not be excessive in terms of the concerns of folks like Larry Summers or Olivier Blanchard that is going to lead to a overheating of the economy. The part that is going to state and local government is going to be mostly spent, but most of the transfers are going to be effectively to household sector. And I think many households, in order to stop losing their homes or being evicted or foreclosure, they'll have to save the money and use it to run down their debts and their arrears. And that's what economic and empirical studies suggest. So it looks like huge on face value, $2 trillion, but the amount that is really spent is going to be only a fraction of it. So it's not excessive.
Nouriel, switching topics just a little bit, though, we also want to get your take just on the SPAC raise and what we've seen play out in the markets over the last several months. We saw a record month for SPACs in January, on track for another record month in February. Is there any risk, do you think, to this?
Well, I mean, the SPAC phenomenon is, my view, as a broader signal that there is, with zero rates on the short end and very low on the long end, there's a mass of liquidity, and the short run is not leading to goods or service inflation, is leading to asset inflation and eventually to asset bubbles. So whether it's tech stocks or the fact that cyclically adjusted PE ratios are well above historical average at 33, whether it's the bubble in cryptocurrencies, whether it's the SPAC phenomenon. Some of it is a signal of this frothiness in financial market because money is so cheap and everybody can borrow and do the investments that may turn out to be good or bad. Some of these SPACs investment might go for the right companies and be high return. Some of them, given there is frothiness, are going to end up with disappointing returns for the investors. So I don't think that all of them are going to be successful. I don't think there's systemic risk coming from the SPAC, leaving aside the fact that maybe there is excessive frothiness in financial markets and eventually a correction is likely, especially if, in my view, some of the tail risk of the economy is going to imply that probably the economy is going to grow slightly less than what the markets are expecting. The market are expecting a V-shaped recovery. I think there are many reasons that could elaborate on why the growth may disappoint to the downside rather than to the upside.
Nouriel Roubini is a professor of economics at New York University's Stern School of Business, also CEO of Roubini Macro Associates. Thank you, as always, for joining us. And Julia LaRoche, thank you for being here as well.